Welcome to the Sojourn Wealth Management Podcast. My name is Jeff Bronner, and I'm joined by Andrew Kraft and Corey Akins. Today, we're going to be talking about a topic that is important for every single listener and individual who has to manage their money to consider, and that is cash. How are y'all doing today?
Doing well.
Doing well, Jeff.
Excited to talk about this thrilling topic.
Same.
Yep. Cash money. Cash is king.
It's important.
So where do we start?
Pink Floyd, money.
Boom, boom, boom.
Yeah.
Yep.
I don't know the lyrics to that song, but
Let's dive into it then. So what is the purpose of cash? Why should we have cash?
I would say right off the bat, one word would be liquidity. And then unpack that a few different ways, but I would say just in case, right? The just in case money, in case, you have an emergency. I was speaking with someone earlier today who had a nail in his tire. So that you want to have whatever, a few $100 to replace a tire on hand, not put on a credit card.
Yeah. Medical emergency, I think, is another good one.
Mm-hmm.
So if something arises that you need cash to cover costs of that. Job loss.
Loss of job.
Yeah, is another one.
Big one.
Yeah. Probably, that would be the most detrimental in not having cash, because then all of a sudden your living expenses are now either being put on a credit card or you're having to take out a loan, something like that.
How much cash for an emergency should any individual have on hand?
90 to 180 days or 3 to 6 months. So, and I would like to say essential expenses too, because if you include everything, right? Like you're going out, like we went to Brewster's Ice Cream 2 nights ago, probably not doing that on the essentials budget. So like if you have 3 to 6 months worth of essential expenses, it's a much more doable goal because that's probably not a vast percentage of your total expenses each month, because we all have things like, we're buying tickets to whatever, right? Or going on vacation.
Going to the movies.
Yeah. Like just the normal kind of things. And so it's a doable goal. And that timeline, the cycle of getting another job is typically within that 3 to 6 month period. So
you lose your job, you want to be able to keep, the lights on, keep food on the table. 3 to 6 months of emergency fund set aside in cash is ideal for that.
Yeah, absolutely.
Yeah.
Okay, so emergency fund. What other purposes might cash have in someone's finances?
On the other end of the spectrum of an emergency, maybe, you could say the word opportunity. Just something comes along that you weren't expecting, whether it's, they're having a sale on cruises in Alaska or whatever, and you have some money to put down on it, as opposed to, again, using the credit card.
You're in the market, or like your ability to get into the market, right? If the market goes down, I think that having cash on hand, and investment managers do this, Jeff, you can probably talk about it, but having cash on hand when the market does go down to invest.
Yeah.
Right. And that's 101.
Dry powder, so to speak. That's something, just generally speaking, that most investment managers will bake into a portfolio, some small percentage, 2, maybe 3%, maybe 5% in some instances, but essentially so that they can keep oil between the gears of the portfolio. So if they ever need to make a trade or anything like that, they're not required to sell something in order to generate enough cash. They have the cash sitting there. They can make the trade and then settle that later on down the road at a more opportune time. Just allows for flexibility there. Again, it's the broad principle, Andrew, you pointed out, of liquidity for accessibility is absolutely true when it comes to taking advantage of any given opportunity.
And think about most people when the market goes down, initial reactions or majority reactions are to get out. If you have cash on hand and your ability to get into the market, you're doing like the efficient thing, right? You're doing the opposite of what kind of everybody who is trying to get out is they're doing the opposite of what is good market investing. It just gives you a leg up in that sense, right? And you're going to be able to experience greater growth that way.
Yeah, just taking advantage of that downturn or that market dip, buying in. The third one I'll mention, I was thinking about this, just met some clients last week, and they were talking about their kids going to college and knowing that expense is coming up. And so of the cash they had, we kind of just earmarked that much, set it aside because they know those tuition bills are coming up. So kind of a known short-term expense coming down the pike. So,
what other examples of short-term expenses can y'all think of that people should keep in mind?
Like a house, more down payment on a house, right? You want to get, ideally, I would say 20% to avoid PMI, but most people try and get at least 10% down. But kind of saving up for that down payment, you don't want to put that in the market and have it go down, and now you can't afford the house that you
got to wait for your house another 6 months.
Right.
What would you say is like a time frame? So let's say someone wants to buy a house in 5 years. What would you say would be a short-term expense time frame?
That's a good question. I would say 5 years is kind of pushing it because in that time period you can see the market cycle.
Yeah.
So I would say if something's sooner than 2 years, then don't really put it in the market.
Yeah, I agree with that. And then like buying cars, another short-term expense that people, you want to save up, put a good down payment on it. And you don't want to have that, like you're saying, Andrew, you don't want to have that, have any risk associated with it. It's not worth it for you to have short-term money that is being treated as a long-term asset when it's going to be operational in 24 to 36 months. So yeah, I think cars and homes, that's the main.
Vacations.
Yeah. Yeah.
A lot of times those big, cruises in the Norwegian fjords. I'm not sure how you say that.
Fjords, I think is how it's.
Fjords. But, you put some money down, and you put some money down later. Well, being able to put that down, save up and pay cash as opposed to, putting on debt is key.
Absolutely.
Y'all had mentioned a Federal Reserve study regarding, this is kind of jumping back a little bit to the emergency fund, but I think it's important for the listeners to know about. Can you guys unpack that study as far as why it's important to have cash on hand? Again, I'm backtracking to emergencies, but can you unpack that a little bit?
Yeah, I don't know what the most recent one was, but the last time I saw was just a few years ago where, essentially if someone was met with some type of emergency or even an opportunity that exceeded $500, they would have to go into debt. So they'd have to, or sell assets, I guess, to fund it. So, but mostly people just put it on a credit card. But some people can have the discipline to go, sell something before they buy something else, whatever. But yeah, that's a pretty quick hurdle to get over when something happens. Two tires are blown, you might be looking at
right.
So.
And that's something we so emphasize with our clients is the importance of financial wellness, and that's a key component of it is being prepared for an emergency, take out debt in order to maintain your standard of living.
Yeah.
Okay, so cash is important. It has good use. Where do we keep it?
Well, I can tell you a few places maybe not to keep it. That's one. Don't bury it in coffee cans and mason jars in the backyard. But in all seriousness, I did hear from some clients a couple years back where they bought a house, and after living in it for a few years, we're going to do some renovations, and busted through the walls and found a one of those old lunch bags full of cash that the previous owner had squirreled away that was his emergency fund, I guess. And so there was a lot of money from I think it was from the 1980s. But I would not keep it there or the proverbial couch cushion.
It was not adjusted for inflation. Is what I'm hearing.
Correct.
Okay.
Yeah.
That is amazing. That's an incredible story.
But yeah, it's just at the local bank, credit union be a great place to keep it. And most of them will offer a no cost, possibly no interest rate, also checking account. But again, we talked about before, accessibility, liquidity. So that in this situation, you're not really looking for a yield. If you're looking for a yield, you might do something else.
Yeah, I think a lot of places will now do a checking account that has some cash back provisions. So that's if you just have a checking account that you're using for your monthly expenses, I think I use that personally. I think there's value there just in getting some money back from an account that is pretty much always going to be low on the interest rate side. But the other place is high yield savings. And so being able to put money into a liquid account that you can access, but is also getting a very competitive interest rate, I think is a really, really good idea.
Yeah, absolutely.
So some sort of, whether it be a credit union, local bank, checking savings, high yield savings type account. What's another place somebody can keep their cash?
Yeah, well, the investment company industry's, I guess, answer to the bank savings account is the money market. So a lot of folks, might, be familiar with that term. They'll mention to me they have some money in a money market, but it's basically just a mutual fund that is geared to have a value of $1 and never change from $1 or what's called break the buck and just get interest. And so, generally it's going to be interest kind of like a savings account. But that's another option, is just a money market.
And over the last several years, money markets have seen an influx of cash into them because of that purpose. As interest rates rose, more and more money has gone there, and that's a great place. Another place is CDs. I think, Andrew, those are not compact discs.
I have a lot of those.
You invest a lot there in your car.
I used to buy like 13 for $1, and then you get another one the next month for like $10. You got to cancel before they send too many.
Like
y'all don't know what I'm talking about.
The Netflix of CD purchasing.
We'll just go down to McKay's.
Anyone who's over 50 will know what I'm talking about.
No, I'm talking about certificates of deposit. So CDs, you put money in. It has a locked-in interest rate. It's like a savings account, but it's locked in for the time that it's given, whether it be 6 months, 9 months, 13 months. And so
you're trading liquidity.
Yeah, for that interest rate. And so if you don't need it, right? Like if you are buying a house in 1 year and you've got a 6-month CD and you're not going to need that cash, yeah, then go for it. Do it. It's a great place. And there's different ways to different strategies to do with CDs, right? Like you could have kind of rolling laddering is what they call it, where you've got ones that are coming out of maturity at different times, and just a way to kind of always have some cash that that is maturing that you can do something with. So like if CD rates drop, you can go back to high yield, money market, whatever.
Gotcha, because they're coming out of maturity and you can do something else with it. Yeah, good point.
Couple things to keep in mind with CDs is they're taxed at your normal income rates. So
the interest
is taxed at your normal income rate. So whenever you realize that the CD comes to maturity, that's going to add to your annual income. And then that gets into the laddering strategy and whatnot. We talked earlier about, once you exceed a time horizon of 2 years, maybe look at different strategies, and CDs kind of straddle that not immediate need, but kind of maybe a year out type thing would be a good way to utilize that.
Yeah.
So one last question. If not cash, what should we do with it? So going back to that, hey, we don't need it immediately. We don't need it in the next 2 years. What should you do with that excess?
I'm so glad you asked, Jeff. Well, I think one of the things that I think people do a lot of is they keep too much cash. And so what happens is you can create some inefficiency that way, where you're either from inflation or just opportunity costs, you're not making what you could on money that's, really not for a short-term expense. It's not for emergency fund. Like you've purchased all the things that you need. That cash can go to the market or go even to other places that are going to get better interest rates than what you see and be more favorably taxed when you do take them out. And so I think there's, without giving a real in the weeds answer, I think have the cash on hand that you're comfortable with for the emergency fund, for the opportunities, for the expenses, the purchases, and then outside of that, it should be
saved to other goals.
Yeah, that's exactly to midterm and long term goals.
Yeah,
and I think of midterm like 3 to 10 years, and then long term 10 and beyond.
And so, like long term investing in retirement stuff, and that kind of medium term investing in other types of brokerage accounts, which maybe we'll get into in future episodes.
Yeah. Well, thank you guys so much for unpacking that incredibly relevant topic. I look forward to discussing more about those other ideas as well in future episodes.
Thanks, Jeff.
Thank you, Jeff.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. The securities offered through Kestra Investment Services LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management LLC.